Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit more about the markets. When we look at the indice returns from around the globe, clearly we've moved into negative territory in most of the markets. Toronto's down 4% on the year. The S&P, however, is up 1%. European major markets, France and London are both down about 5%. Germany still hanging on in positive territory, up about 1%. Both major Asian markets, Hong Kong and Tokyo, are down about 1%. What we've seen is markets have clearly rolled over here on softer data. And I'll give you an example. A year ago, the TSX was 16% higher than it is now. And so fairly significant sell-off, Chris, in a period of a year. And then since March, it's down 10%, and the month of May was basically a disaster, down 6%. So it's sort of like, really accelerate on the downside. My point here is it does come to an end. It doesn't perpetually keep going like that. But the three main culprits that we've talked about, at least on the economic front, are basically to blame for this. That's China and the Eurozone and some US data. So why don't we start with China, Chris?
Sure. Well, the economic data that's been coming out recently, and we're talking about the last 2 months, has reversed a trend of positive data. Now we've started to see negative trends in the data. The Purchasing Managers Index, which is an indication of future economic activity, has trended down, sitting at 50.4, which is just slightly above an expansion level. And we started to see gross domestic product revisions to the downside. The Chinese government said they're probably likely to grow at about 8%, and we've seen revisions maybe below that in the 7 to 7.5% range. And so the debate that is going on and will likely continue to go on for some time is whether China experiences a soft landing, they can engineer a slowdown and then a reacceleration, or whether we actually see a hard landing in that country.
Right. Chris, so there's an element of uncertainty to that.
Absolutely.
And that's what the market's having a problem with. If we turn to the Eurozone, well, a couple things this month. We're going to see another election in Greece. The outcome is unknown. The direction that the policymakers in Greece take is unknown. We're back talking about Spanish bond yields. Who knew that would ever matter, but apparently it does. As well as the capitalization levels in Spanish banks. So the credit issue and debt issues in Europe continues to sort of mow along. What the market doesn't like about that is the outcome is uncertain, and therefore it creates negative sentiment.
That's right. If we turn to the US, similar to China, we've seen a reversal in some positive data. Most importantly, I think, is the jobs numbers. Recently we saw jobs down considerably from what the estimate was, and not only that, but the prior month was revised lower. This has caused a continued move into US Treasuries for safety. We've seen US 10-year Treasuries fall to about 1.5%, and of course a corresponding increase in the strength of the US dollar, and that's sort of the indication of that fear trade.
Right. So again, we're talking a level of uncertainty now. What's happening in the U.S. In the heartland, in the industrial areas, wouldn't say it doesn't look good. It's just the data is now trending in a different direction. Brings us to this notion that we've heard before, like several portfolio managers over the course of a bunch of months have tried to say that the global markets are not necessarily connected as much as we think. Chris and I have never believed that. We actually believe they are very connected because they all seem to be moving in lockstep. Different numbers, but the trends seem to move in a similar direction.
That's right. There was a lot of talk about decoupling. So if Europe was going into recession, well, that's not likely to have a big impact on the U.S. or on China. But in fact, after decades of moving towards globalization, you can't all of a sudden say that that trade between these countries is not going to have a negative impact on the U.S. or on China, and that's what we're seeing in the numbers that are coming out.
Yeah, very much. So they're all rolling over at the same time in the same direction. So what should somebody be doing here, Chris? Well, we look at markets like this, and first of all, markets always miss on the upside and the downside. So if we're off 16% here in a year in the TSX, which is primarily commodity and resource related, that can't go on like that. markets do hit a bottom, so we're just telling people to be cautious here, but don't be afraid. Some of the names that you may be watching should probably be pretty interesting right now, particularly on the yield side, which if you listen to Chris and I, you know that's our story over and over again, that yield is very important. So just a couple of things to consider there.
Yeah, absolutely. Make sure you work with your advisor on building a shopping list of things that you might like to own. You don't necessarily need to jump into them right away, but start to watch them, and when they get to a price that you feel comfortable with, the yield will probably be higher, and you know, if you do your homework up front, you'll have the opportunity to buy those down the road. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue our discussion around the dynamics in capital markets. So until then, I'm Grant.
And I'm Chris.
And we're the Two Investment Guys.